Hello everyone, this is Justin Smythe from nextbigtrade.com. This is the index review for December 27th, 2024. The S&P 500 bounced this week, but my best guess is the S&P 500 remains in a correction that started 3 weeks ago around the early December timeframe. A couple main reasons for this is the number of stocks that are starting to not participate in this rally continues to grow, and there's signs of speculative excess that's happening in some of the hottest sectors like artificial intelligence, quantum computing, and drone stocks, where a lot of small cap stocks have now made parabolic moves to the upside. That tends to occur towards the end of major rallies in the stock market. And while this has been occurring, again, less stocks have been participating over the last few weeks, with a lot of foreign markets in particular that are breaking down. And that leads to the idea that this correction is going to continue into the early part of 2025, and perhaps the S&P 500 will once again retest the 30-week moving average at least, while it hasn't retested this moving average basically at all except for 1 week in August in 2024 during the biggest correction of the year. So this has been a mostly just a nonstop up period for the stock market since the October 2023 bottom. There's been a couple of corrections in 2024. They've been short in duration, and I think it's probably likely that the market will spend more time in correction in 2025, and patience really is going to be a critical attribute of trading success, waiting for these corrections to play out and then going long stocks when, after the S&P 500 has had a correction and becomes a tailwind for individual stocks. When it's in a downtrend, like it is currently, it's a headwind for individual stocks, and that's why it's better to short or stay in cash when the overall trend is to the downside. On the daily chart, the S&P 500 basically went back up and retested the same resistance area that it faced a couple weeks ago when this correction started. Then we had a breakdown on heavy volume just last week with a big bounce on Friday. This was a shortened trading week. There was 4 days to the week. The first part of the week, the S&P 500 bounced, and you can see how the volume overall for the week was lighter. And then on Friday in particular, the S&P 500 broke back below the 20-day moving average, stayed below it by the close. It did bounce off the 50-day moving average, but overall the trend is starting to take shape to the downside as we found resistance at a critical area, and then we're breaking below the 20-day moving average. So as long as the S&P 500 remains below this 20-day moving average, which is the trend indicator in the timing model, it's another indication that we're just going to continue into a correction over the next few weeks. The NASDAQ 100 was up just slightly more than the S&P 500, but during a shortened trading week, again, volume was on the light side. Not a lot of big activity in mega cap tech stocks. Just like the S&P 500, the NASDAQ 100 sold off at the end of the week. It did hold above the 20-day moving average, but this is a key level to watch next week. If the NASDAQ 100 starts to lose this moving average, that would be a bearish sign. The NASDAQ composite was up slightly more than the S&P 500 this week. Now the Russell 2000 is where things continue to struggle. This has now underperformed the S&P 500 for about 5 weeks in a row. And notice how this topped a couple weeks before the S&P 500. So a lot of weakness in the small cap indices, which doesn't have a lot of technology stocks. And then if we jump down to the daily chart, we can see how the Russell is really struggling with this critical technical level that's been in place pretty much all during the second half of 2024, where it was finding the 222-ish area as resistance for multiple months, then broke above it after the election, tried to find it as a support, but broke down below it last week, and then now is finding that area as resistance. You can see how the volume came in on Friday. Heavy volume to the downside. Small caps finding resistance there. They look like they could be ready to roll over below the 30-week moving average. And again, this critical area is finding the market's finding it as resistance again after temporarily breaking above it, but having a key breakdown last week on heavy volume. The VIX did bounce this week and is hovering right around the 10-week moving average. If the VIX continues to break out next week, that would be another bearish indication for stocks. It's basically in position to break out, so we'll see how it acts next week. The advanced decline line in the NYSE continues to now remain unfavorable below the 10-week moving average. As long as this continues, this is another negative indication for stocks. Moving on to breadth, S&P 500 did bounce this week after being, oversold after a big sell-off to start this correction, but you can see how it started to move lower towards the end of the week, and it's likely that we're going to have another, potential washout in breadth as this correction continues. And then looking at NASDAQ 100 breadth, this still has plenty of room to move to the downside before it becomes oversold as this correction continues as well. So there's plenty of room for especially the mega cap stocks to come under pressure now if the overall market remains under pressure over the next few weeks. So overall, the S&P 500 appears to remain in correction. This was a slow holiday shortened week, but there's not a lot of stage 2 breakout activity. Basically, the hot parabolic sectors are extending while the rest of the market is acting weak. And this is leading to the idea that a correction will lead us into the new year. And I think the first quarter of 2025 is going to be all about staying patient and waiting for a great opportunity, probably when most of the rest of the market is washed out and frustrated again after a major correction to start the year.